Today, we need to talk about a crack that's forming in a massive, hidden corner of Wall Street. It's a market worth trillions of dollars, one that promised investors safety and high returns. But right now, it looks like the emergency exits are starting to lock.
So let me ask you a question, just straight up. What if you went to your investment account, you clicked withdraw, and the answer you got back was just no? Not because of a mistake, not because you didn't anything wrong, but simply because too many other people were trying to get their money out at the exact same time.
You know, that might sound like some crazy hypothetical, but it's not. This is happening right now to investors in a whole bunch of funds that are collectively worth more than $172 billion. For them, it is very, very real.
And that is essentially the message that's being sent out. We're talking about some of the biggest names in finance here. BlackRock, Blackstone, Morgan Stanley. They've started putting up the gates, telling investors, sorry, you can't have all of your money back right now.
I mean, just look at these numbers. At BlackRock's fund, investors asked for almost 10% of the fund's assets back, but the fund only paid out 5%. It's the same story everywhere you look. Blackstone, Morgan Stanley, Cliffwater. Investors are rushing for the door, and those requests are surging way past what these funds are allowed to pay out.
Let's just zoom in on Morgan Stanley's fund for a second. Investors wanted to pull out almost 11% of the fund's total value, but the gate was slammed shut at 5%. They were asking for more than double what the fund was ever prepared to give back in one go. You see, this isn't just a small leak anymore. This is a flood of money all trying to get out of the same tiny exit.
Okay, so where is all this actually happening? Well, it's taking place in a part of the financial world called private credit. That's basically lending money directly to companies, cutting out the traditional banks. And it's a huge part of what people call the shadow banking system.
Now, shadow banking isn't some shady, illegal thing. It's really just a name for a system that does all the same stuff a regular bank does, lending money, managing cash, but it does it without the same strict rules. And more importantly, without the same safety nets. We're talking no FDIC insurance, no guaranteed government bailout if things go wrong.
And this isn't some small niche corner of the market. The private credit world alone is estimated to be worth $1.8 trillion. And when something is that big, a problem there doesn't just stay in the shadows, it spills out.
So, what is the fundamental problem here? Why is this happening? Well, it all boils down to a massive design flaw, a problem that finance folks call a liquidity mismatch.
Think about it like this. These funds were sold to investors with a big promise. You can get your money out every 3 months. But the money inside the fund is tied up in these long-term private loans to companies. And those loans are incredibly difficult to sell quickly. It's like promising someone they can use their house like an ATM. You just can't get cash out of a house instantly. And you definitely can't do it with a private business loan.
Right, let's put it in even simpler terms. Your savings account at a regular bank, it's liquid and it's insured. A private credit fund, it is the complete opposite. It was sold as this amazing way to get stable, high returns. But what wasn't on the billboard was the hidden risk. Your money could get locked up at the exact moment you and everybody else needed it the most.
Now, for years, this whole structural problem kind of went unnoticed, at least by most investors. But now, a perfect storm of economic pressures is hitting all at once, and it's turning this hidden risk into a very, very real crisis.
So let's trace how we got here. It all starts back in 2021, when interest rates were near zero, and companies loaded up on cheap, floating-rate debt. Then, boom, central banks started hiking rates like crazy, and all that cheap debt suddenly became crushingly expensive. Now you layer on top of that brand new pressures, like AI disrupting the software companies that these funds love to lend to, and geopolitical conflicts sending shockwaves through the market.
So you've got all these triggers firing at the same time: geopolitical risk, AI disruption, and a rising tide of corporate bankruptcies. And what makes it even worse is that a lot of these loans were so-called covenant light, which is just a fancy way of saying they had very few protections for the people who lent the money. All of this is building towards something that Wall Street is nervously calling the maturity wall. And believe me, this isn't some abstract theory. In 2026 alone, $162 billion worth of those private loans are coming due. These companies have to pay back their old debt by taking on new debt, but they're walking into a world where borrowing costs are way higher and lenders are getting very nervous.
This is exactly why the alarm bells are going off. Mohammed El-Arian, who is a top advisor at Alliance, put it bluntly. He said this situation feels like a canary in the coal mine moment, similar to August 2007, and he chose that date for a reason. That's the moment right before the subprime mortgage crisis blew up and kicked off the global financial crisis.
Which brings us to the big one, the question that really matters.
What does any of this actually mean for you? Why should a problem in some obscure trillion-dollar market matter to your retirement savings?
Well, here's how the contagion spreads. It's a chain reaction. Step 1, the private funds freeze withdrawals. Step 2, the big institutional investors, we're talking pension funds, insurance companies, they are suddenly strapped for cash. So what do? Step 3, they're forced to sell what they can sell. And their most liquid assets are stocks and bonds. Which leads to step 4 and 5, that huge wave of selling pushes down the value of the exact same assets that are sitting in your 401k.
And what's really terrifying is who is holding all this risk now? Over the last decade, you see, the big sophisticated institutions have been quietly reducing their exposure. And who rushed in to fill that gap? Everyday retail investors, who for years were desperate to find any kind of decent return. They were sold a safe product that is now showing its true colors.
So the most important thing to remember here is that this problem doesn't just stay put. It doesn't care about the wall between private markets and public markets. A crisis that starts in the shadows almost always ends up spilling over into the light, hitting the very pensions, insurance policies, and retirement accounts that millions of us are counting on. Which leaves us with one final, pretty uncomfortable question. The whole sales pitch for this $1.8 trillion market was that you could get great, stable returns without the crazy swings of the stock market. But now that the exits are locked, you have to wonder, was that promise ever really true?